I would say the investment trust sector in general, across all underlying asset classes, remains extremely attractive. It's not as attractive as it was a year ago when discounts reached a record wide level, but it's still very attractive relative to history. And as I said, this is across sector, going from equities to alternatives, and within alternatives, we can talk about infrastructure, for example, where the valuations are at a 30-year level of cheapness. We can look at other areas like niche sectors such as healthcare and biotechnology, which we think is particularly attractive with record level of innovations, an M&A market which is picking up, IPO market which is also starting to recover, and a record number of drugs which are being approved at the moment.
The first is UK domestic economy-related companies, in particular around house building and construction and infrastructure investment. So these are high priorities of the new Labour government. We know that volumes of activity have been very low over the last couple of years in a high inflation, high interest rate environment. And we're optimistic that the combination of inflation and interest rates coming down and more emphasis by the Labour government on these areas of activity are going to mean real pickups in growth next year. And that relates to a bunch of different companies and sectors, house building, construction companies more broadly, some big ticket retail companies and so forth. But that is an area we are really optimistic about.
A sluggish economy is difficult for retailers, but we've got some of the world's leading consumer discretionary stocks. These companies are running up the down escalator and gaining share due to their scale, some offering value, while others offer scarcity and exclusivity, all benefiting from margin-enhancing investments. Walmart, Costco, TK Maxx, Hermes, and Next have this star quality.
And many of our industrial companies in the UK are international businesses that have good niche market positions. Industrial activity has been pretty weak over the last year or two globally. Manufacturing has been difficult. There's been a lot of inventory in manufacturing systems. And again, as we've worked through that over the last year, we're optimistic that activity levels will start to recover quite sharply around the world as we move into 2025. And our companies are, generally speaking, very well placed to benefit from that pickup in activity.
So things like the critical energy infrastructure or the world needs more energy, as you can see behind me. We've been focused on that for quite a while. And the names have been performing really well. So the energy portfolio, we've been overweight for a long time, since around 2018, but it's changed significantly over time. So it looks like we always have sort of 15 to 20% of the portfolio in energy. But it started out in the late teens with oil and gas, exploration and production. And it has shifted over time to where we are now, just almost completely focused on critical energy infrastructure. So things like wires, cables, gas turbines, nuclear, switches, transformers, all that stuff that it takes to get electricity, to convert natural gas, which is our preference, into electricity, or nuclear into electricity, and moved around to where it's needed to be.
Another key driver would be the green transition. So as we move away from the carbon economy and try to improve the energy efficiency of our buildings, of our manufacturing techniques, we think, again, that is going to continue to drive very strong growth for companies that have exposure to that space. It won't be a straight line. Policy decisions will affect near-term investments, but over the long term, we would expect very strong demand as a consequence of that driver.
I think two areas that are probably still attractive in the world of fixed income, despite the rally in spreads that we've had, would be financials, so banks and insurance companies, and also parts of the asset-backed security markets, and in particular, CLOs or collateralized loan obligations. Looking at financials, for example, and comparing them to the spreads or the yields that you can get in the corporate bond world, you're picking up between 100 and maybe 150 basis points of additional yield looking at banks or insurance companies in comparison to what you get for similarly rated corporate bonds. When you consider that these are industries that are, maybe the most highly regulated industries in the world, I think this is a very attractive proposition, and I think it means that the spreads can continue to contract between banks and the corporate bond world. As regards CLOs, this is an area that is complex. You do need a big team to, I think, analyze and manage CLOs correctly. Here at 24, we have a big asset-backed securities team, and I think that helps us to add a lot of value to the dynamic bond fund by incorporating asset-backed securities into our positioning.